Welcome to today's Explainer. We're diving headfirst into ICICI Bank's Q1 2026 earnings report. Now, if you've ever stared at a dense, jargon-heavy corporate balance sheet and felt your eyes completely glaze over, don't worry, you are in the perfect place. Today, we're going to take those sprawling spreadsheets and translate them into a clear, fascinating picture of one of India's absolute largest financial engines. To make all this data perfectly digestible, we've broken things down into a quick 5-step agenda. We'll start with the Q1 performance overview, break down the revenue, look at deposits and advances, check out the asset quality and health, and then wrap up with some key takeaways and the outlook.
All right, part 1. Let's get a bird's eye view of their Q1 performance.
Whenever a massive, multi-page earnings report drops, every single investor, analyst, and curious observer out there really just wants to know one thing right off the bat, right? How did the bank actually perform? We always need the big headline before we read the fine print.
Well, here is your headline. The bank pulled in a whopping 14,804.5 crore rupees in net profit for the quarter ending June 30, 2026. That is just a massive, highly impactful number to drop right out of the gate. And remember, this is the pure cash left over after accounting for all the day-to-day operating expenses, taxes, and provisions. Just 3 months of work and boom, over 14,800 crores.
To hit that incredible bottom line, their total quarterly income absolutely smashed past the 54,000 crore mark. Specifically, they hit 54,246.84 crores. Now, to get down to that net profit, they obviously had to subtract some heavy lifting, things like over 21,000 crores in interest expenses, plus their operating costs. But still, arriving at that spectacular net profit is a serious win.
Moving on to part 2, let's peel back the layers and break down exactly where that mountain of revenue actually came from.
Slicing up the revenue reveals something pretty instantly. Everyday retail banking is the absolute dominating powerhouse here, bringing in over 42,000 crore rupees. Right behind it, we have treasury operations at over 37,000 crores, and then wholesale banking chipping in with roughly 25,000 crores.
It's honestly fascinating to think about. The absolute lion's share of this giant's revenue relies on you and me, everyday consumers using personal banking products. When the report talks about retail banking, they're explicitly talking about credit cards, debit cards, and third-party product distribution. Sure, the massive corporate megadeals are the ones getting the flashy news coverage, but it's literally millions of individual swipes, taps, and daily transactions that are truly fueling this bank.
Okay, on to part 3. Let's open up the vault and talk about deposits and advances.
This is where we really see the sheer scale of their operations. The bank is holding over 1.83 million crores in deposits, against 1.63 million crores in given advances, which is essentially bank speak for loans. This is the fundamental tug-of-war of the banking business model. You take money in, pay interest on it, and lend it out at a higher rate. That delicate balancing act between these two astronomical figures is exactly what generates those massive income numbers we were just looking at.
When we zoom out to the broader official balance sheet and factor in all their investments, cash, and fixed assets, the bank's total assets for the quarter hit a staggering 2.43 million crores. Just let that sink in for a second. Over 2.4 million crores. When experts talk about a bank having systemic importance, a colossal footprint like this is exactly what they mean.
Part 4. Let's tackle asset quality and health, which is the elephant in the room for any major financial institution.
Before we throw more numbers around, it's crucial to understand what we're actually measuring here. An NPA, or non-performing asset, is essentially just a loan that isn't getting paid back. It's in default. Tracking the percentage of these bad loans compared to the healthy ones is the ultimate vital sign for a bank's risk management. If this number creeps too high, you know the bank is heading for trouble.
But looking at this data, there are absolutely no red flags, which perfectly explains those huge profits. The bank is showing a very clear downward trend in bad loans. Last year, their gross NPA ratio was at 1.67%, and today it's down to 1.38%. And if you look at their net NPA ratio, which factors in the money they've already set aside to cover these defaults, it's down to a microscopic 0.35%. So they are lending out way more money than before, but managing the risk better than they were a year ago. That is a massive sign of health.
Finally, part 5. Let's speed run through some key takeaways and the outlook to wrap things up.
Behind all those flashy revenue numbers, the board has been incredibly busy. They just appointed Mr. Mugang Paranjape as a new non-executive independent director for a 5-year term. They also approved a revised borrowing limit which lets them raise up to $2.5 billion in overseas markets, a pretty clear signal of their international funding ambitions. And for a bit of regulatory housekeeping, the RBI directed them to make a standard asset provision of 1,283 crore rupees, specifically regarding agricultural priority sector loans, just to make sure all compliance boxes are fully checked.
The report also gave a nice shout-out to their co-lending arrangements, or CLAs. This is where they team up with other financial entities to share credit risk. Right now, they're successfully managing over 11,310 active cases under this model, with a gross outstanding amount of over 1,579 crore rupees spread across home, property, and business loans. It's a fantastic example of how they're diversifying their lending strategies beyond just traditional direct loans.
So that wraps up our explainer on these Q1 results. I hope this gave you a really clear structural picture of exactly where ICICI Bank stands today, but as we close out, I want to leave you with one final thought to chew on. Given the dropping bad loan ratios, the exploding retail sector, and these staggering multi-trillion asset milestones we've just looked at, exactly how massive can India's private financial engines safely become in the next decade? Something to think about. Thanks for joining me.